I just want to welcome everybody. Thanks for taking time out of your day. I'm sure everybody is busy hauling, getting some grain moved with these great prices, and before the roads get posted, I hear that that's a lingering issue out there. So, yeah, we appreciate your time today. I just wanted to make a quick plug for our new app that's going to be launched on Thursday. So look for the details coming out on the Alcivia Powered by Bushels app. You'll be able to download it. It is free to use. It's going to be similar to the customer portal, except it's just so easily and accessible through this app, all of the details, and we'll make sure to get all of that information out to you. But that's just a quick little sneak peek on that. I wanted to introduce Taylor. Taylor is with Advanced Trading. He's been there about 10 years. We use him as our market advisor and broker. He is a wealth of information. We really appreciate him coming on and giving us some insight to these volatile, to put it lightly, grain markets. And hopefully we will all walk away with a little bit more information. If not, I mean, there's nothing certain, but at least we can have a plan going into the next year and make sure that we're locking in some profits. So we appreciate your time this morning, Taylor.
Yeah, definitely. It's a fun time. I did, limit up again today, and see what tomorrow brings. There's a lot of stuff happening. We'll try to talk about a little of that here. Then just kind of how do we manage risk in this environment? Because it is difficult, or opportunity maybe is another way to say it, because there's a lot of opportunity here. It's a pretty good time to be in ag. We've come off these kind of the tight range here, this 6 to 7 years where it felt like you needed to sell the high in July, and if you didn't, then it was kind of frustrating at times. And we're moving into this, I think, kind of a newer environment here. I don't know how long this lasts, but as we've seen in the past, and you got to go back a little ways, back into 2010, 2008, where we had higher prices, and that it's often accompanied by volatility. And so you get the high prices, but you do get the high volatility. And so it can be stressful and challenging, but there's a lot of fun in it too. So I thought I'd go through just a couple of current headlines. We're not going to go into S&Ds and all that stuff. Michael in the previous presentation covered some of that, but just kind of a few hot button things, what's happening, some what ifs. I wanted to talk a little on biofuels. There's a lot happening in this space. It's really interesting. It's going to change. It's changing, and it's going to change, I think, agriculture quite a bit, like the ethanol market did, and then just get into some strategy. So Ukraine obviously is the big one in the room right now, and what's happening here. How much of an issue is this? Right now they ship, a little over 30 million tons of corn a year. It's a lot. They're one of the larger world exporters. They ship around 24 million tons of wheat. That's about 12% of the world trade. Russia is currently still exporting grain here today, from what we've gathered. I think some of your countries in Africa and stuff that buy wheat are just going to keep buying wheat from Russia. That'd be my own opinion of that. But how big a deal is this, the U.S. balance sheet? We are seeing quite a bit of demand come back. It hasn't been announced yet, but the cash basis is really supporting it in the West Coast and on the river markets too. And so to the private estimates here, somewhere between 3 million tons at least of demand. I think they've got around 8 million tons of corn on the books. Ukraine does. I mean, if this was a prolonged event, that's a lot of demand. Just at 3 million tons, that's close to 100 million or 120 million bushels. And that's not really in the balance sheet today. So this is, the market's still working through this. We're really seeing it. If you do follow spreads too, the inverse is growing in the market. Like the May July corn spread today is up 7.5 cents to 21-cent inverse. And so the market's really saying, like, we need corn, and we're seeing all this demand come in for April, May. So it's getting pretty exciting. Where does I'm not sure where the futures market stops, or where does it need to be in this environment? I don't know. We're still really very much in this discovery mode at the moment, and going to be in a volatile environment. I should just mention, they're probably going to cover it in the fertilizer breakout session, but Mosaic, one of the larger world fertilizer producers, they sent out a slide packet the other day, and they said, the Russia, Ukraine, they're about anywhere between 15 to 25% of pretty much any major fertilizer product. And so there's just a lot of implications here for agriculture and a lot of unknowns. Stepping back, inflation has been a big thing. As we look back last year, commodities outperformed pretty much everything else. And this is a comment from Goldman Sachs. The best place to be in a market like this is commodities, and you can feel it just before this whole Ukraine situation. The out of the Feb WASDE report, you would have thought, given the stocks to use, that we'd have corn prices somewhere around between $5 to $5.50, and we were trading like $1 over that. And I think some of that is just due to this. We've had outside money coming into the market. They're trying to hedge their risk and buying ag commodities, buying crude oil, buying these types of things. It's a fairly low risk investment to help hedge their risk, and so that's what they're doing. There's money coming in into that market, and so that's kind of made some stuff a little bit distorted, more so than we've typically seen. And then you throw this, the Ukrainian situation in, and it's another challenge. And then the next thing that we need to worry about here in a probably a couple months is really weather. And we've got a La Nina that's been fading, although it's not dead yet. It looks like to extend kind of out into late spring, early summer. We've had a lot of the hallmarks of a La Nina this last year. We had that wet weather in Australia, which led to more feed wheat. We had dryness in Argentina. That's pretty much ending now. Like our weather guy is starting to call kind of a favorable, or he's kind of pretty neutral on weather. We had a real wet, northern Brazil crop, that had some impact on the beans, and then really the dryness in the southern plains. And I just want to focus on that for a minute. So this came out like a week and a half ago in mid-February, and this is the 3-month outlook from the CPC with NOAA, and they're seeing that La Nina trend continue, that dryness in the southwestern plains, the warmer temps, the cool, wet P&W market, and then wet and a little warmer in the eastern corn belt. I was at a meeting last week in St. Louis for Illinois Grain and Feed, and they had Drew Lerner of World Weather talking. He's definitely looking at this too, kind of concerned, as are several other weather forecasters, thinking, if we don't get some precip to come in here in these southern plains and get some moisture in the ground before temps really warm up, it tends to be hard to kind of, dampen that heat dome down, and then that can expand and cause a summer drought in those states. And I'd say that's something to be pretty cognizant of. I'm not trying to wave the, the bull flag here and get people fired up. That's not the intent. I just want to bring that up, though, just from a risk standpoint, is there is that chance that it's not ideal weather right now for how it looks. So keep an eye on that. The 1-month forecast came out yesterday. It was generally fairly similar to this, not quite as extreme in the dryness in the west, but still kind of in that same vein. So keep an eye on that, just as it is one of the things that could add some volatility to the market. Let's talk about biofuels for a few minutes here. So a year or so ago, we had the government came out and they gave a RIN credit out to renewable diesel. And so we had some of these older facilities, like Marathon has one up in North Dakota, and they've started to go into refining renewable diesel. So they're using feedstocks such as tallow, corn oil actually is a really big one, and then soybean oil is another really common one. We've had a fairly tight world balance sheet of soybean oil, or just oil in general. And so that caused this big demand last year for soybean oil. It encompass most of a crush margin's margin was soybean oil, more than, I think it was like we were over half, and definitely a change in the market. And so we've got these producers making money, and we've got some of these older facilities out there, and they're looking to continue to ramp this up. And so in 2022 here, we're looking to add another, go up to 1.3 billion gallons roughly. Some of this probably doesn't all happen in 2022. It's just some of these projects just take time. And as you know, things are hard to get, parts are hard to get right now. So let's just assume half that gets built. If it does, and say half of that goes to soybean oil, because not all of it will be, that's approximately 284 million bushels of beans, or at 50 bushels an acre, that's like 5.7 million acres. So it's some real demand that could be coming more probably on the latter half of the year. And then you can see here on this data, we've got more and more of these facilities planned, and there's a pretty big, not just in the U.S., but just in the world, this push to, renewable diesel and trying to find other things. There's sustainable aviation fuel that's being looked at too, like ADM at their dry mill plants, Columbus, and like Decatur, and some of these guys are looking at, could we get into that, utilize our ethanol plant for aviation fuel? I won't spend any more time on that, but it is a big demand thing. And so what's happened, right? It's kind of been this like Oprah Winfrey giveaway. We've got like everybody getting a soybean plant. Fortunately, not Wisconsin yet, but we have one coming south of you. This is just a list of all these plants in the last, couple months that have been announced. A few takeaways on this for me. One, it's not small companies. This is people with big money. This is your ABCs, as we like to call them in agriculture, your ADMs, Bunge's, Cargills, CGB. You have AGP, a big processor more out west. They're looking to build a couple more plants. The one closest to you guys, Marquis, down in Hennepin, Illinois, they're going to expand their that whole just complex. They're looking at aviation fuel on the corn side, and then they're going to build a pretty big plant on the soybean side. So just more sucking sound down there. Incobrasa down in Gilman, Illinois, is expanding their facility even more after having expanded quite a bit here in the last couple of years. So just a lot of demand. If you tally that all up, it's just shy of 580 million bushels of demand. And a lot of this is happening pretty quick. This is not 5-10 years out. This is 1 to 3 years. Do all these get built? I'm not sure. And do we see some of these older facilities come offline as we bring new ones on? Likely. I just don't know who that is yet. We've got a few older assets out there, so it wouldn't shock me if, we lose a few processors over the years. But what's the impact of this? I just did some math. Wisconsin's not in this because from a crush standpoint, but just looking at some of these western states, because this is where the demand's coming, and just trying to think about how big of an impact this is to the balance sheet. I took the 5-year average soybean production for a lot of these states, and then took the current crush demand, and then just look at it. What's the percentage of production? Iowa, your neighbor there, is 85% of the production goes to demand today, local. Minnesota is quite a bit at 70%. Illinois, not as much, just under half. If you expand this crush demand out and say acres stay the same, and production stays the same, we're going to take some states to some really tight levels, like Iowa. It goes, we're just going to start demanding more than we produce. Minnesota is going to almost evaporate as far as how much exportable surplus they have, what's left over after they crush. Illinois tightens up quite a bit. So there's a big change here. I mean, one challenge in this is typically like a good P&W export program. So the West Coast, where like a lot of fall river beans went this year, that tends to be somewhere in the 450 to 500 million bushel. And if you go through this math on here, we don't really have that kind of surplus to meet that demand, or it just covers it. And so there's going to be a lot of changes here. What happens with all this meal, right? I mean, how does that work into rations? It's going to need to find outlets for it. There's exporters looking at how do we export meal? Is that something we want to do? What happens to world buyers? China especially has been set up to crush beans on site. They've built a lot of capacity, so much so that they don't even use it all. So what do they want to do? Do they want to buy meal, or do they want to keep buying beans? And if so, how do we do that? How does the market reconcile that? What happens to distillers, on the ethanol side? If you've got all this high pro meal trying to find a home, that is bearish distillers demand. So how does that all offset? There's a lot of things here that are going to change. I think we're going to see a lot of whipsaws, and just you're probably going to hear some crazy basis numbers and things over the next couple of years as we all try to digest this and figure out how to work through these new changes in our environment. And finally, I guess, how much does the farmer change? How much do you guys change from an acreage standpoint? Do you make the switch? If people want to just farm their rotation, and it would look like down the road here in the next, especially next year, not this upcoming, but the following, we're going to need more bean acres to help meet demand. So with that, let's get into some strategy and talk through, how do we manage this? Last year was really a home run. We had 2020 costs, which were relatively low, generally speaking, and we had just excellent revenue opportunities. This year, we're in a different environment, right? We've got a cost that is record, in some cases still a bit unknown. Can you get chemicals? Can you get fertilizer? With seed cost? And then you've got this unknown revenue that, like last week, would we change $1.05 in a day in soybeans? So it can really swing. And how do you protect your business in this environment? I just wanted to highlight a little on volatility first, just to give some perspective here. So this is looking back at the last 14, 15 years of ag and corn, and just looking at the high to low price over the course of a year. And this last year, we're coming off about a $3 range. And you can see here, going back, just a couple years ago, we were under $1 trading range from low to high. It's a really narrow band, and that lasted for quite a while. And you got to go back, to these 2012 era where we had these $3 ranges in corn. In fact, just already this calendar year, not including today, because I did this math yesterday afternoon, but we were $1.34 range already this year. So, add to that, since we're at new highs today, and we're probably close to $1.50. And so we're already exceeding quite a few years here in the last decade. And so I think that's important, as I'm going to talk a little bit about utilizing call options or put strategy. And back in these years here, you could say, well, Taylor, why would you spend 15, 20 cents? And that ends up being a quarter, maybe a third in 2017 of your total volatility range. And I get it. And in this market, though, we're not talking about that tight of a range anymore. We're talking about it's a really wide one. Are you entering here on a low, or are you entering it on a high? I don't know the answer to that. And I'm very confident to say that there's a lot going on. There's a lot of unknowns, and I'm just trying to respect that. This is a fun slide just to kind of highlight that volatility, because it has felt like a lot. This was a colleague put this together a few weeks ago, and just looking at the amount of time corn trades plus or minus a dime. And last year we were about 30%. This year we're about 30, and that's anywhere from 3 to 6 times what we were the last 5 or 6 years. So it's a lot more volatile than we've been. And soybeans, fairly similar. So we're coming off over a $5 range last year, and the year before, that's 2 to 3 times what we were seeing in previous years. Before this morning's rally, which we're at, No, we're not at new highs in the May contract. So we've already traded at $4.10 range today in beans for this year. I mean, we're we're just starting March. It's kind of unbelievable to be double that of like 2019. And so there's a lot of money at stake here, and how do you manage that environment, which we'll talk about here. And then just similar on beans too, we're at over 60% of the time we're trading more than a dime market, and this is double what we've seen the last few years. So how do we, protect margin, and then how do we limit this fear of missing out, right? Because that's what a lot of this is. I was doing some meetings last week up in South and North Dakota, and I started one meeting, with a limit up day, which was kind of fun, and then after, I talked for about an hour, we were down to up 13 cents, and kind of felt bad that it maybe took up people's time. And then the next day I was at a meeting, and guys were just like, how do you manage these emotions, and just really struggling. It's hard. You're like looking at the screen and going, wow, we're up this much. What do I do? And then it pulls back. And so I like to keep it pretty simple. Old crop corn, I put these together this morning, so it's probably changed a hair, but just give you a relative idea here. We've got an inverted market today. And in most cases, there's no cash carry. And so I lean toward just selling the cash and then following up here, just, I don't know if 25 cents is the right amount to spend, but as you do sell more of your grain, and you want to limit that fear of missing out, you can just follow that up with a call option, and gives you the right to be long the market without having that downside exposure. As the previous talk, stuff really did change in the world market. Ukraine gets stuff situated, which they eventually will. I just don't know when. You could see prices come down a lot. Yeah, there's a lot of risk there for sure. So, buying a 25-cent call, I think that's a reasonable way to do it. And more importantly, you got to manage that call. And so this is just an older example, but what we like to do at Advanced Trading is always having orders in. So if you own that call today, put an order in to sell that call and buy one 10 cents above that, and be able to do it at a cost of about 2.5 cents, so where you can basically put 7.5 cents in your own pocket, and it's just continuing to roll that up, and take money out of the market as it gives it to you. And this market that we've seen here in the last week has definitely been an opportunity for that. I was using a lot of these same slides last week, and just kind of going through the numbers and being like, oh my gosh, wow, like my recommendations changed a lot because the market's moved a lot. And if you had bought that, you could definitely have rolled several of these up to a higher strike, taken money, put it in your pocket, and then continue to move forward. So I just think this is a nice, simple strategy to try to, you're not outguessing something, and you're still in it, and you can root for higher prices and not get backed up against the wall. Real quick here on new crop corn, pretty similar to that. You could look at doing like a min-max contract where you buy a call and sell one above it. Couple caveats on that. One, I would definitely make sure you have a call that is way above your strike price of where you buy one, well above it. In this example here, we're $1.50, and that gets your cost down to something more reasonable because it is really expensive. You could buy a short dated call too, which is what's over here. So this is based off the Dees contract, and it allows you to basically protect that upside opportunity. And then it expires though at the end of June. So it does, it gets you through a lot of this risk window, but not all of it. And because of that, they're quite a bit cheaper. So like a 650 call there is 39 cents roughly, and then here it's 61, so it's not 20 cents cheaper roughly. As you get higher in your percentage sold, if you get over 25-30% cash sold, in my opinion, I would really kind of stay out of the short call market today, just given the volatility that we're seeing and that risk. And that's when you haven't sold you don't have your crop yet, you haven't planted it, you don't know what it is. If those weather models happen to come into into play later this year and we do have a drought, I just don't want to have that cap. That's you might not have the bushels. You're just going to limit yourself. That's not a place you want to be in. Instead, what I would look to do is I would just go out and buy like a July short dated put. And what this does is it gives you a floor in the market. So if we keep going higher, you've got protection. Or if you keep going lower, you've got the protection. Sorry, if we keep going higher, what you need to do is similar to the call, you just manage it. And so what we like to do is just roll that put up to a higher strike. And you're going to have to pay a little more money for this. We'd recommend don't do this unless you can do it for, say, 2.5 cents. Roll your strike up and just continue to raise your floor. Subsequently, if the market pulls back, you can roll your put down and take money out of the market and put that in your pocket. So let's walk through an example of what this looks like with crop insurance. I just made an assumption here of 85% insurance that may or may not be where you're at. I was asking Josh yesterday, said 180 APH, that probably catches most of you for an average, and we're at 590. It's a pretty astounding, Fed guaranteed price here. So if you think about that in dollars per acre, it's about $903 an acre. So if you do that 580 put, you less your 27 cents, that gives you a futures floor of 553, right? Your strike less your cost. You walk through that 553 times 180 bushel. You're basically ensuring revenue now with this put option of $995, and that's about $90 over your insurance floor. So it gives you protection even over where your crop insurance is today, and it helps you stay bullish without having to go out and sell something that you haven't grown and having that risk out there. I think this is a great tool. If we continue to see this market rally here, I'd be walking through this math and continuing to look at it. You might say $90 isn't enough for me to want to go out and spend 27 cents. If this becomes $150 an acre or $200 an acre, there's a point here where you do need to start stepping in my opinion, and manage that downside risk. I think we're only supposed to be about a half hour, so let me just kind of breeze through beans really quick. It's pretty similar logic. In beans, I would, sell cash or buy a call. In old crop, you do have, you know what you've got. You've got a little bit more limited risk. So you could look at doing like a min-max in beans, buy a call, sell one above it. Just know that, at $19, if the futures market were to rally up there, you're capped. You can't make any more money than that. So you're going to get, you'll have your net gain of the difference of those two strikes, and then you're out to some extent. And so that's your risk there versus just being long the calls. At new crop, similar to corn, I would look to go, if you make some cash sales, I would follow that up with some options today, just given the risk in this market. I would, very much caution against selling anything, like even $1 above where you were at. So that's why I have $19 strike here. So $3 range, that gets your cost down a little bit to 50 cents. So it's more manageable. But then I'd say after, 30% sold either via physical or via some option strategy, I would just keep it to more of a put strategy. And let yourself stay bullish. Don't try to call a high or cap yourself or cause any challenges there. In beans, using that math, so it walk through the same insurance at a 50 bushel an acre APH. You're about a little over $600 an acre on your guarantee today. If you use that $14 July put, that's a $13.56 futures floor, and so it's about $70 an acre, over your insurance floor. So not quite as much as corn, but there's money there. Today there's downside risk, so as it's similar to corn. I just continue to manage that. I just continue to watch it as the market moves here. So with that, I think we've hit our half hour. So yeah, if you got any questions, glad to take those. If you want to talk specifically about what's happening in the market, glad to talk about that too. So, or anything else for that matter.
Yeah, thanks, Taylor. Anyone can feel free to put any question that you have in the chat, or go ahead and unmute yourself and ask the question if you'd like. We can hang out for a few minutes and see if anyone has anything.
Let's see here. How would an escalation in conflict, including more countries, impact grain fertilizer markets? At what point do we look beyond 2022? Good question. I'm not an expert on fertilizers, so just right. Yeah, in fertilizer, so I can't quite speak to that. I mean, there is a lot of production that comes out of there. They're a large world exporter. I don't know how much, like Mosaic. I used to be in the mining world, and Mosaic has a huge mine down in Florida, a big strip mine. Like, I don't know if they can ramp up production there or not, like where we're at for stuff like that in those markets. In grain markets, you know, if we extend the conflict, you know, you could get to a point if Ukraine is, you know, not in the world market for a while. I haven't run through these numbers, so please, you know, with that caveat. But I think you could get to the point where you actually need people to ration demand, and that would not be a great environment to be in. You'd have to take prices up really high, and then at the same time, you know, spreads tighten and all these things, and tell the world farmer, you know, Brazilian farmer really should be pricing or planting as much safrinha crop as he can, and really try to bring those acres on. It would just be a really tight environment, and definitely a challenging one. So it could happen, you know, if we take that out for a while. Let's see, John asked here, your roll-up strategy does not count broker fees. You really want to roll up every 10 cents. Yeah, you are correct. I didn't put those in there. I'm, you know, depends on your fee. That's why, so on the 10 cents, yeah, you might not, if the market's moving quite a bit, yeah, maybe you say, maybe it's every 20 cents in that environment. It's, you know, in beans maybe, and if we're moving a lot in the bean market, maybe you do that. They just kind of feel that market out a little bit and say, you know, if we're moving and dimes to 20 cents a day and something, and it's really moving one direction, then maybe you would do that. And that's, I'd say, on the cost, the broker fee thing. That's why we've got it at like 2.5 cents, you know, 2 to 2.5 cents, somewhere in there. And because you don't want to keep rolling this for the sake of just rolling it, and yeah, fees and all of that, that's not worth it. And that's where we've kind of landed in that neighborhood, is where we feel that's a good value to you, to do that. And it's not perfect, you know, I'm not sure what there is a right number per se on that roll, but just the general strategy, though, I think is what's key.
If we go back, Taylor, you and I had talked a few days ago here, and remembering back, what was it, about 9-10 years ago, when we went through the grain market rallies, and it roughly lasted about 1.5 to 2 years. And and I had asked you, you know, I don't remember what happened, and you kind of spoke to the ramp up of world supply, and I think that comes back around to Kevin's question about beyond 22.
Yeah.
Can you speak to like how things ended up settling out about 10 years ago when we went through this type of scenario?
Yeah, some of that was a little before my time, but yeah, when I was at least in agriculture, but yeah, we did bring on a lot of, I don't have the numbers in front of me. I wish I did. I talked through them, but we brought on a lot of production, and specifically, really, where we're having the issue now is in the Black Sea. So, I mean, Russia has just, you know, really grown their wheat acreage up a ton, and they're a major world exporter now, which wasn't the case probably 10 years ago, off the top of my head. Ukraine too has become a really large player in the corn market and the wheat market. And then we've brought on, safrinha acres. Just Brazil, has grown tremendously, and so we told the world to plant corn. I didn't have a slide in it here just for the sake of time, but if you look at, Ukraine, Argentina, Brazil, from a corn standpoint, everybody's making money. And so we're just telling the farmer, keep planting. There's definitely acres in Brazil. They don't always get planted to safrinha corn every year. Some areas of the country, they'll just grow the beans, or they'll maybe follow it up with another commodity. And so if we keep taking corn prices up, we're going to see, I'd say, more of those, bean acres get followed up with corn. And we'll probably see some more growth too. This is not I don't know this market very well, but the last few years, you're starting to see like Romania, South Africa on occasion, can be more of a competitor. It's not a lot, they'll have a few million tons here and there to ship of corn. But I think you'd probably start telling those guys, plant corn, and we'll start growing that in those markets too. It just starts little by little.
Yeah, thanks, Taylor. I think
Yeah.
the key takeaways is taking advantage of these prices. If you are looking to capitalize on the large swings, sell your cash and put some type of strategy in place. And we need to look at managing our risk moving forward, because the world responds to higher grain prices with more grain. And that's just the fundamentals of supply and demand, aren't they?
Yeah, they're tight. I think at Goldman Sachs, they had to do a weekly podcast, and they had said, the 27 commodities they watch, they think every one of them is in a supply issue. They've got tightness everywhere, and so everybody's pretty bowled up on the commodities at the moment.
We hope you all have a great day, and we'll talk soon.